Welcome everyone back to our 55th edition of this weekly Wook and Review. I'm going to walk through some interesting stories from this week for the prepared material if it's your first time tuning in. Joe's going to read a little disclaimer here and then we will get underway. And if you want to participate, obviously if you're joining this live in Spaces, feel free to chime in via text or join in as a speaker. And also you can watch the stream live, my screen share in the GME Discord server in the Stages channel. So with that, Joe, over to you.
Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual.
All right, very good. With that mouthful out of the way, thank you for putting this week's newsletter together, Joe. I guess we've probably got 3 stories. I feel like we keep coming back to some of them, but I know people do like talking about some of these topics. So we could talk about automotive a little bit. Again, we talked about Tesla on Wednesday. I'm actually looking forward to talking about kind of this 60-40. There's a story this week out of Wall Street Journal on 60-40 strategy. Does it kind of default, 60% equities, 40% bonds, portfolio? And I had asked a question earlier this week, which I did a poor job of wording the question because I forgot to include the word real returns. So we'll talk about that and see what people want to talk about when we get done. So I guess let's get automotive out of the way off the bat. I mean, I don't want to rehash all the Tesla discussion from Wednesday. I'm sure people will tune in and want to talk about Tesla more, as they always do. But onto what's a little more interesting, at least to me, you've got some updates both this afternoon and this week on the UAW strike. So the kind of delta between what UAW wants and what the OEMs are willing to pay is narrowing. There was a scoop from one of the Bloomberg writers that cover the auto industry less than an hour ago, talking about. I guess let me bring it over to this side of the screen. Talking about that Stellantis, in addition to General Motors, has met Ford's 23% raise offer, and the UAW is asking now for 25%. So it continues to get closer and closer to a resolution. It's good to see that the UAW has now, I think, gone 2 weeks of not really ramping up the battle, the strike against the big three. So it sounds like they're, again, if the OEs are at 23 and the UAW is at 25, you're pretty close to a resolution, right? You're not going to have, months more, in all likelihood, famous last words of striking over that narrow of a gap. So let's see what it ends up being. I mean, mathematically, I would assume then it sounds like 24% is going to be what they settle on. Which, again, to tail it back to Tesla, okay, we know that the big three have the highest cost labor currently. So if we think about the big three index at 100, OEs like, let's use Tesla as an example, non-unionized OEs like Tesla, Toyota, the Korean OEs, the Germans, all of the OEs that produce in the South, and in non-unionized shops, and maybe they're indexed at something like, let's call it 75, 80. Well, now if the OEs go up from 100 to 124, yes, this is just labor, but you're talking about something like a 65% cost premium on labor that the big three are going to have relative to non-unionized shops. Now, presumably, when this deal goes into effect, it's going to cause other companies competing for automotive labor to pay a bit more. We'll see. But obviously, Tesla would not want that to be the case, given their margins have been cratering as they've cut prices. And while they've presumably taken more cost out of their manufacturing model, it's just math. When you cut price 20 whatever percent, your profit margins go down unless your costs are falling faster, which they are not. So pretty poor results out of them earlier this week. Again, not to beat the dead horse, they, as always, are pumping their narrative about the future growth avenues. We get at the end of November now the Cybertruck reveal, and it will be interesting to see how many Cybertrucks come out of the woodwork to buy that, and at what price they are willing to pay for that. So that also dovetails with the last story Joe included here, was about GM delaying their Orion assembly plant that was going to be making the all-electric Silverados and Sierras, which they've pushed it back by a year. It's a sign that at these prices and at these interest rates, which Mr. Musk liked to talk a lot about on Wednesday, demand is clearly lower than it is in a ZERP environment. So you got other OEs pushing back, the dates they're going to bring these commercial products to market. You got Tesla saying we're finally going to have the semi-truck on 11/30 announced. Let's see how that happens. I still am very bearish Tesla, just given how obscene of a premium it trades at relative to the other OEs, and the math is panning out. It's not looking good. The PE multiple keeps expanding as the earnings keep going down, and the price stubbornly is staying in the stratosphere. But we're closing back in on a triple-digit price to earnings at this rate if Tesla earnings continue deteriorating. So we'll see what happens. But okay, that's automotive, Joe. Anything you would add?
I want to make sure I heard you right, Rod. Did you just call them cybercucks?
I
That is
did.
hilarious. I've never heard that term. I love it. It sums it up pretty damn well. I'll go ahead and I'll present another story from the newsletter for us. It looks like we didn't talk yet about you mentioned the 60-40 split. I think you did a poll on that, so I'll let you take that one. But I'll go ahead and talk about the home sales. So yeah, I included this story on the home sales falling in September to the lowest rate in 13 years, showing the corner of the economy most weakened by high interest rates remains in decline. And go ahead and I have this chart here that shows the U.S. median existing home price change from a year earlier. As you can tell, it's down quite a bit, and it wasn't not so long ago, just a year or two ago. It was up over 20, near 25%, and now it's sitting at a measly 2.8. But yeah, I mean, just real world experience of this is I live in San Diego in a neighborhood that's pretty ripe for gentrification. It's a very private neighborhood, and a lot of the homes were built here a very, very long time ago, like probably 60, 70 years ago. So a lot of old homes, and when I first moved in here about 2 years ago, there's plenty of homes being renovated. I couldn't really drive down the block without seeing construction going on, homes being torn down and new ones being built. But now it's nothing. It's silent. There's no construction going on. People have stopped remortgaging their homes for additions because obviously the interest rates, and I don't think there's too much demand for new homes to be built in the neighborhood because of, again, the interest rates. So that's just my lived experience
Well, the other issue in something like a San Diego is that it's probably all like old single family bungalows. And while a developer, I'm sure, would be happy to put in some, you know, multi-story, multi-family if they could get a row of them, the city of San Diego isn't going to allow them to change the zoning, and it's going to be stuck with these, multi-million-dollar single-family
Yeah,
bungalows that doesn't really address the housing
yeah, it's
crisis.
true. And there's also uh, a cap on how much your property value can increase every year, as long as it maintains in the same ownership, whether or not it's a trust or not. It doesn't really affect it. But regardless, if like the home I'm living in is
And
purchased
and
brand new by the same people that own it today, and the property value as declared by the city, $60,000 to $70,000. But in reality, it's a home that Zillow estimates to be worth over $1 million. So they're paying $800 to $900 a year in property tax. But if they were to sell the home, the buyers would not be grandfathered in to that rate. They would, the house would be reassessed, and who knows what they would have
right
to pay.
now, that's interesting. I don't know how California works, because if someone's renting out a property, like in the state of Florida, if I bought the house, and I stayed there as my primary residence, I get to take advantage of not being as subject to rising prices and rising assessments. But if it's a rental property, you don't have those protections, at least in Florida. So that's a little surprising to me that California allows that.
Yeah, but if the owners were to sell the place, the new owners would not be, subject to the same low assessment. I think it'd be
Yeah.
reassessed. But I think the cap is 1 to 2% per year is the max your home values to go up, according to the city. So that's why. So I think, a few years ago when homes went up 10%, 20%. I mean the city said, it's actually only a 1 or 2% according to the taxes. So yeah, that's my
Hmm.
lived experience here in Southern California.
So I put a graphic on, again. If you're in Spaces, you obviously can't see my screen. If you're in the GMEDD Stages channel, you might not be able to do back and forth audio with us from there, but you can see this graphic. It was in one of the Bloomberg newsletters this morning, um, kind of showing data from Redfin, which is graphing the required income for a prospective home buyer to purchase the medium priced home with a 20% down payment at a 30-year fixed rate mortgage. So you've got several moving parts in that calculation. You've got the value of the median home. You've got the interest rate on the 30-year fixed rate mortgage. But what you can see, and this graphic starts from 2012, is that back in 2012, which was close to the trough, it was some point in 2012 that I believe the residential real estate nationwide made its bottom. But the average required income for that median home with a 20% down payment was only 30 some odd $1,000. And you can see that the chart has moved up and to the right, unfortunately, evidence of deteriorating affordability. And we're now at, after a massive surge, which is, again, if you look at when the chart surges, look at early 2022 interest rates. Um, so the fact that price has stubbornly remained high or even continued somewhat appreciating while rate has gone to the moon, you've got a jump from what was, say, requiring a $75,000 income at the start of 2022 to buy the typical home with a 20% down payment. Now you're at 114,000, which, again, that is not the median American income. That is far above the median American income. So it's really just another data point, another way of looking at what we've talked about for some time now, that housing affordability has absolutely plummeted. And the stuff that you need to think about that's interesting is, like, what are the second order effects of that? Well, people, or not people, but businesses that benefit from housing transactional volumes. So typically, when people buy a new home, or there's a transaction, there's furniture that's purchased, there's other durable goods, appliances. All of that stuff is really slowed down. And if you believe our friends at Hedge Retail, they did a presentation today talking about how they still think that the outlook is too optimistic for, say, the Home Depots, the Lowe's, the Floor and Decors, et cetera, of the world. So there are many implications for many people about housing supply and transactional volumes just being in essentially in a depression. And now you just have price remaining so high for these assets that I guess if you're somebody who did buy a house in the beginning of 2022 or the end of 2021, now you have the golden mortgage handcuffs that you're tethered to. But it's complicated, and obviously housing is very local, so it really does matter. Like you in SoCal have your idiosyncratic kind of considerations, Joe. Me in kind of the Tampa Bay area. Unfortunately for me, it's because people want to keep moving out of the Northeast to Florida. We have, I think, the highest inflation rate of any MSA, or it's been battling up there in the top highest inflation rates for a while now, and I've perceived it and seen traffic increasing and congestion and some of those negative effects. But I mean, the real economy here looks pretty damn strong. When I drive by, the restaurants, I still see them very packed and busy, and it looks like people are quite content to continue to spend here.
I will say, Rod, when I was in Tampa like 2.5 years ago, and I went in the ocean, it was the best water, the best temperature. This was in the middle of the
We don't
winter.
have an ocean.
Oh, I'm sorry. The not the ocean. You know what I'm talking about. You know what I mean. But
the Gulf of Mexico is a hot tub.
It is
yes.
so warm. It was amazing. So it is a shame that you do not enjoy that more often. Because I remember last space we brought this up. You said you haven't been in the water in a long time.
Oh, yeah, we actually went out to St. Pete Beach, one of the beaches in Pinellas, for my, I guess, call her mother-in-law, her birthday. It's one of those restaurants that like rotates at the top, so that was kind of cool. But yeah, I guess I did dip my toes in the Gulf, and it was warm.
Yeah, there we go. Good. Yes, that's the best part of Florida. The best part. I will say, was this like a Lazy Susan restaurant? What's going on there?
What's that?
It's spun? The restaurant spun around?
Here, I'll Google it because it's the name. Spinners is the name of it. Spinners Rooftop Grill.
Revolving dining room.
Here you go.
Oh my gosh.
Here, let's put the 3D on if you're following along. You can see this is over in lovely Pinellas. Sometimes. All right. So okay, housing. We talked about housing. We talked about automotive / Tesla, whatever you want to call it. Let me finish then with the one I thought was interesting, and I'll welcome and anyone who wants to chime in, feel free. But I included this one. There was the Wall Street Journal story earlier this week I mentioned, talking about the 60/40 strategy. Last year was the worst for that strategy. Again, 60% stocks, 40% bonds. It's a very typical investment allocation approach, especially for folks who might be a little closer to retirement. The hope is that the bonds provide some ballast for the equity side of the portfolio, but we got a very weird, unusual year last year where bonds did horrifically and stocks did bad. So that strategy lost 17% last year. And all right, great. I'm not going to rehash the story. I put a poll out though, and I thought this was what I'd like to talk more about, because this is something we've talked a little bit about on, I think, this program and some of the weekly Wednesday calls too, this notion of investor expectations broadly still being too high. And, I said just before I made a mistake when I did this poll, I did not specifically define are we talking real returns or are we talking nominal returns? Because it could have skewed this. But you can see on my screen, and maybe Joe, you can pin it while I'm talking to the Nest for folks who are just on Twitter, the poll I ran. But I asked, what long-term annual return are you currently anticipating from your equity investments? So, asking what are investors' equity investment annual return expectations. Again, I should have defined whether this was in real or nominal, but let's disregard my error there. 1/3 of respondents selected less than 8%. And if you actually go back and look at your history, going back to the 1800s, the long-term real rate of return for equities has been somewhere around that 7, depending on precisely the starting point, it's somewhere between 6.5%, 7.5% for equities. So real return, something, let's call it 7%. So if you're expecting less than 8%, then you're actually more in line with long-term real returns. A lot of respondents, though, a little less than 1/3, responded 16% plus for the expectations from their equity investments, which there certainly are many companies that have returned more than that, and there will be companies that return more than that. But to me, it kind of highlighted that there's still a lot of people who have very high expectations that I think are out of touch with the environment that we are operating in, where, going back to the home discussion, asset prices are already still awfully high. It's hard to get a good forward return when you're starting at a very high point, right? You would rather be buying when it's at the low. Therefore, your forward returns should be higher. But I think expectations are still pretty high. People are still willing to take a lot of risk. And it goes back to the discussion that we were having, I think, internally in our team meeting earlier this week. We also talked a little on Wednesday about it, this notion that, well, okay, if maybe you're the tranche of respondents who said less than 8 and 8 to 12, which was about 60% of them. Well, if so, then Howard Marks would say, well, why are you even in equities if you're expecting below 8% or in the 8 to 12% tranche, when right now high yield corporate debt, where you are a contractual, you stand in front of the equity holders if there's a restructuring of some sort or a bankruptcy, you have a higher priority claim than the equity holders, and you in high yield can get almost 10% right now. Granted, that's obviously not guaranteed. You could have some of those high yield bonds default. But I think it just highlights, and there's been a lot of discussion, not just this week, but for some time now, about the relative attractiveness of bonds versus stocks. And yeah, I just wanted to maybe see if people want to talk a little bit about that. I know it's definitely, for me, as somebody who's younger and almost always been invested in equities, given I haven't needed to be or wanted to allocate to bonds, and it's definitely just eye-opening when you think about the yields you can get in credit compared to what you think you can get in equity, knowing that inherently an equity instrument is riskier than a credit instrument. So I don't know, Joe, what do you think? What are you looking to get on your equity investments? And again, if anyone in the audience wants to chime in, feel free to request to speak.
Like I've mentioned in previous spaces, I keep most of my cash allocation in Robinhood's cash sweep program. It's easy enough for me to access it should I need to make a trade quickly, right? There's some great high yield savings account out there that can maybe do a little bit better than Robinhood's, I think 4.9. Let me check what it says. I can pull it up. Let's see, 4.9% APY with gold. So that's what I'm making on most of my cash. And then if I need to invest in something quickly, right, I can do that because it's already in Robinhood. It's already readily investable, pretty much at a moment's notice. If I need to make a trade, I can without waiting several days for it to be pulled out of a high yield account and then deposited into my brokerage. So while I don't have the best opinions on Robinhood, and I did have to speak with their lawyers, was it this year? Yeah, this year, several months ago, 6, 7, 8 months ago, something like that. I will continue to take advantage of their cash sweep program because it's the best flexibility I've found in regards to my availability of the funds versus, a high yield account, which is going to take some time to pull out of.
Okay, so I'm going to re-ask the question again. What are your long-term return targets for equities?
So,
Do you,
go ahead.
I guess I'm being an asshole.
Yeah.
No, I mean, look, I think the Robinhood Gold is a decent offering. I mean, Interactive Brokers, your uninvested cash, you'll get, what is it, like 483 or 488 right now. I use, because I prefer, you'll get a slightly higher yield on, say, SGOV, which is the ultra short term government bond fund. So SGOV is an iShares product that it's basically, buying treasury bonds that have remaining maturities of anywhere up to 3 months. So the average duration is like 0.1 something. It's very low duration. Has a 7 basis point expense ratio, and right now you're getting what is the 30-day yield? It should be higher than the Fed funds. Yeah, 5.2. So a little bit better than IBKR and Robinhood. You're gonna be able to, in a margin account, transact the same day. If you say sold the SGOV and wanted to buy another instrument, you'll be able to do it that same day, as opposed to your point, having to do an ACH transfer or a wire or whatever from a high yield savings elsewhere. But
Totally valid point. For me, it's just that 0.3% extra is not worth the work. Not worth the few hours it'll take me to set up.
Oh, I mean, it takes a minute to click buy, but
for me, it'd be my first time. I've never bought a.
You can go into your Robinhood
before, so
Joe, with your cash in your Robinhood account. You can buy, I assume. I don't see why you couldn't go in and buy SGOV, but yeah, I'm not telling you to do that.
No financial advice.
Giving you a hard time. But I mean, this is the kind of the quandary again. As risk-free rates have risen, the relative attractiveness of higher risk equities declines. I mean, if you can get 5, 6, you could buy, again, using the high yield, which again is not investment grade, so there is more risk there on the corporate side, but you could assemble a portfolio, a diversified portfolio, pick your fund manager du jour on the bond side and get 9+%, owning credit instruments. It definitely makes one reconsider, equity. And I know I've been giving that a lot of thought lately. But yeah, not seeing anyone else yet request to speak. I mean, we've gone through, I think, the material in the newsletter that Joe sent out that we wanted to. So if anyone wants to chime in on investment return expectations, on housing markets, automotive, other, feel free.
One major topic of the week, because we talked about Tesla's earnings, and I also saw a clip of Palmer Luckey talking about this as well. Work from home. Elon blamed a bit of the lessened demand for Teslas on work from home, and he's pretty much an adamant opposer of it. So I think just bring up that topic, see what everyone's thoughts. I'll see if I can find the Palmer Luckey video where he talks about it. It was on Twitter, but yeah, I'll see if I can find that. And it's just interesting. It's interesting because it really is unprecedented. Ever since COVID, how quickly workforce changed from going into the office every day to maybe going in the office 3 times a week or 2 times a week or even less than that. A lot of jobs now are fully remote. So
Yeah, there was a Wall Street Journal story on Wednesday, so I just put it on my screen here. The headline was "Come in 3 days or just quit." Some companies give remote workers an ultimatum, and it has several different examples of companies with those policies. And I know I've heard from uh, my girlfriend works at a GSIB, one of the big banks, and that's something that big tech, like all these companies, many of them are actually using this because they want to raise their natural rates of attrition because people love work from home. Um, Even though Mr. Musk doesn't, uh, most employees do. And there's going back to the housing discussion. You thus had an exogenous demand shock for work for housing, for single family housing, right? If you have an office, that properties become more valuable as the mix of the populace that seeks working from home, that seeks, having a home office increases. So on the counter to that is commercial real estate, of course, office space becoming less valuable. There's less demand for it. So like a lot of companies are going through this now where maybe it's a variety of things. They're trying to get a better sense for the exact amount of uh, office space they need to satisfy their workers. I've seen several Ryder, who I used to work at, they sold their headquarters building in Doral because they felt like they could downsize into a smaller space. CVS has sold office space. So I think it's less likely that it's going to go back to what it was before COVID. I think that structurally, um, working from home is going to remain higher, and it will be very interesting though to see as companies, the Fed beige book, which we didn't talk about yet today, and we didn't really talk about on Wednesday, but there were several kind of data points in there talking about how companies are trying to pull back on their cost of labor and whether it's paying remote workers a little bit less or other means. It's all part of the conversation. So, but Chad requested to speak, so we'd love to hear what he has to say on the matter.
Hey guys, it's actually unrelated to what you were just talking about. Is that okay?
Sure.
I just wanted to see if you guys have had any experience with, um, don't jump down my throat, but bankrupt companies like Chicken Soup for the Soul, um, with the Revlon and all of that stuff. Um, in your years of experience, in the markets, with these companies, do you recall, um, bankrupt companies and their tickers just disappearing from brokerages? Um, and to the second part of that question, um, your experiences with these tickers disappearing from the brokerages and not being issued any kind of equity in the business that it merges with or gets bought out by. End. Period.
Um, can't say I've done a whole lot of investing in bankrupt securities um, in my couple decades, I guess, of investing. So I don't know how to answer that. But when a company does go through the bankruptcy process and their bankruptcy plan cancels the lost corporation's equity, that's what happens. The lost corporation's equity is gone,
Let's
and the new entity will be owned, in some capacity by the creditors of the old entity. But every situation is going to vary based on the facts.
That's weird because it seems like a lot of these companies, like, I still own Sears, I still own Blockbuster, I still own Toys R Us. and they're all still sitting there in my brokerage, and those were like 10 years ago, you know.
This sounds like a very promising portfolio.
Oh, dude, you should see how many Qs I have in my stock, my brokerage for sure. Um, but just wondering, like those ones are still there. So I'm kind of wondering, like, if you say that, once it's done the bankruptcy, that's what happens. It just disappears. But
No, I mean every bankruptcy plan is going to be a little bit different. I will admit I haven't really looked into those other companies.
okay.
Not really interesting to me, but at least in the case of the company that disappeared on September 29th, and people this week are now surprised. Some apparently are surprised that don't read the SEC filings, or they only opt to ignore the words they don't like in the SEC filings, that when a security is extinguished, has no further force or effect. That means just that. It is gone.
Well,
It's
it's
canceled. It has
interesting.
no further
It's interesting
rights.
because this is a market talk, so I figured you guys would have a lot of experience in the markets, if you're telling the 19 people that were in here when I joined. Um, there's there's a few in my portfolio that did the exact same thing, all within a couple weeks of the one you're referring to. You can just say it, Rod. It's Bed Bath and Beyond. Um, Party City also.
Well, it's not Bed Bath and Beyond anymore because they've sold that, so they've had to change their name. But yes, that one is gone for the old Lost Corp equity holders. You're right.
Don't belittle me. Um, yeah. So
Oh, well, we don't need to have this conversation anymore because you're not going to add any value to the room. So I've removed you. Thanks. Let's get back to talking about stuff that actually matters, not canceled securities.
I will say it's a bit sad of a situation. It's the holding on to hope. I do feel bad for people that were stuck in the trade and didn't exit because they were at a loss and didn't know what to do, and then the shares get extinguished. Which that
I
was
mean, it's just
stated.
really sad, the hive mind that a lot of these social media networks have led to, where people do not think for themselves and they proudly go along with what their internet friends say. And look, unfortunately, your internet friends who are claiming to have a differentiated view, who are new to financial markets, are not going to know better than the market writ large in most cases. So it's really sad, the people that have lost a lot of money because they went along with, believing the very charismatic people online. The people who claim that they have unwavering conviction, even though the security's literally been wiped off the face of the earth. That's all well and good that you can write flowery language, but it doesn't change. It doesn't change the process. And I see a lot of angry apes are now requesting to speak, and I guess if we want to hear them say "cacaw," then cool. But and it's not adding any value to anything.
Yeah, just earlier today, I finished wrapping up compiling the requested documents in the Bed Bath & Beyond litigation that's going down, and yeah, it's Cohen responded to the litigation saying that the share's been canceled. What's left to litigate? That's what his lawyer stated in a letter to the plaintiff. So yeah, I'm still compiling the stuff just because I don't, have a fancy lawyer like him, but it's just a matter of people really not taking responsibility for their own trades, and it's unfortunate. We read that disclaimer at the beginning of every space, and just some solid advice, honestly, for some. Do your own due diligence. Do a lot of research. Don't believe everything you read on the internet, not whether it comes from Rod and me or anyone else. Be questionable. Always be suspicious of anyone trying to get you to donate or get you to tune in and buy apparel or whatever else some of these grifters do. Just always be suspicious.
thing I'll ask you, Joe, why is Bitcoin up 3% today when most risk assets are down? Any thoughts on that?
Digital gold, right? No, I don't know. It's funny. I did see there was a story was it this week or last week, where people had believed that the ETF had been approved. The Bitcoin ETF was approved, and then Bitcoin shot up, and turned out moments later that it was not approved. So there was a huge pump and dump in Bitcoin. I think this was last week. Let me see if I can find a story about it and pin it.
Yeah, if your profile says stuff like shorts never closed, hashtag BBBY, we're not going to bring you up to speak. So you can leave. Yeah, I'm waving to you too, Victor. Have a nice day. And removed. It's really not that difficult, folks. Go to your own little monkey space if you want to talk about flinging poop.
I will say I was in Bali earlier this year, and the monkeys, impressively intelligent. I'm telling you, these monkeys, I saw them. What they would do is they would steal tourists' phones and sunglasses and things like that, and then they would barter with the tourists to get food. So, like, if you hand them a granola bar from your purse, they will give you back your phone, or you give them a berry or a nut, and they'll make a deal with you. It's hilarious. It's some of the smartest monkeys I've ever seen, and took a selfie with one of the monkeys, and it held out its hand as it was holding the phone because it knew that one of the handlers would feed it a berry if we got a funny picture together. Like they're very smart monkeys. I will say they may be smarter than some of the monkeys in the stock market.
Sounds like they're making much better trades.
Yeah, they're making great trades. They're making phenomenal trades. They're taking out margin, which is people's phones and wallets, and they're getting berries and peanuts and granola bars in return. It really is something to look at. Quite the experience. I can only imagine the fun visits to the zoo that could have been afforded by money lost in Bed Bath. It is quite unfortunate. Go to the zoo, guys. There's a zoo here in San Diego. I just went recently. A lot of children crying. You got to ignore that. But the animals, great. Gotta love them. Saw a polar bear, which is pretty cool. Saw some giraffes. A lot of cool animals. I don't know if there's any zoos over near you, Rod. Maybe you get sick of the apes. You don't want to go to the zoo.
I've always been a big fan of. We have some great zoos here in Florida. I was a member at Zoo Miami when I lived down there. We'd go often. One of the larger zoos in the country. Lowry Park Zoo here in Tampa is a fantastic zoo. I highly recommend folks check either one of those out. But look, just because you want something to be true, and because you read a lot of people who use language that confirms your bias online, it doesn't change reality. So again, if if you want to come in and just talk about a canceled security, like think about what you're doing with your time and your life. There's you could be learning about plenty of things rather than doubling and tripling down on what has been a sinkhole of both capital, time, and energy.
Rocket Randall, how you doing, buddy? While we wait for him to unmute his mic, I'll look around. I mean, we do have like a bunch of requests here from the apes. Maybe I pick one and allow them to come up and say something hopefully productive.
I can assume that the first two words are going to be a three-letter word. Two of them back to back. Well, I guess it's a two-letter word because it's a CA and then it's a CAW, right?
It's
Cacaw.
We have someone on Discord sending me a message right now. Alert piano. I don't know what you're Twitter username is. I'll bring you up. You're kind of an ape, apparently. That's okay. We're all kind of apes.
Oh man, I just got to go through the list and block all of these. Oh God, people, look, we don't care about you. Genuinely don't. Literally want nothing to do
All
with
right,
you people.
cohort. Yeah, actually, let's see. You got the dog. You got a dog. I mean, come on. Can't be that bad. All right, cohort. I brought you up. It still says requested on my end, but it says you're a speaker. You may need to drop and come back. I don't know why it's not bringing you up. Being a little glitchy.
All right, I'm again gonna just go through, and if your profile makes it clear what you're here for. Yep, if I see you quote tweeting an old roaring kitty tweet with a butterfly emoji, I'm going to remove you from the space. Goodbye, OF grads. Let me see. Yep, here's
I missed
another
that
one.
guy. I gotta miss Keith Gill. I totally understand why he, left the public life. I don't think he ever anticipated.
Oh, I have to block and
what
remove them,
what happened.
otherwise they can keep coming in.
But I gotta miss Roaring Kitty. He was great. All right, cohort. I brought you up here again. Says you're connecting.
Yeah, if you're liking Kais Malej, the guy who literally should be in jail, if you're liking his tweets, I'm gonna block and remove you from the chat. And if you thumbs down, it makes it very easy for me to know that I should block and remove you from the chat. Yes, thank you for making it easy Boca bound with your butterfly and your images of grifters in your PFP blocked and removed. Very easy.
It's a shame. I'll never look at butterflies.
Go waste your time somewhere else.
I brought cohort up, but it looks like he lagged out. Randall, how are you today?
I'm good. How are you? Can you hear me?
Good.
All right.
Yeah, we
2008 MBS short looks like he wants to talk about Bitcoin and not Bed Bath, so I will let him chime in. And hey, Randall.
Hey.
Yeah, man, go ahead.
That's pretty good, actually. I don't know what the joke was.
All right. I know that
nice
apes have set up their little chat rooms to spam sending in their burners. So, I mean, please just make it easy. Put the butterfly in your name so I can immediately block and remove you.
It is actually hilarious how bad the fake accounts are. They can't help but like some tweets about Bed Bath, and it makes it very obvious when they're coming into the space. Why don't you guys just go on, make a burner, and like all of Rod's tweets? Then we would, bring you up thinking you're a big Rod fan.
No, I get enough of those from all the bot account sex bots that Elon's platform is just overrun with.
$1 a year to eliminate the bots, right?
Yeah, Elon's just a piece of shit. What a liar. It was never anything to do with bots. Just can't stand that guy. I am enjoying seeing this platform become less and less valuable.
Cohort, what's going on, buddy?
But...
Cohort, this is like the third time we've brought you up. Is your microphone working? You are muted.
I would love if Andrew, if you wanted to talk about some stuff, because you've been around for long enough to have actually been investing in earlier in the 90s when we had positive interest rates and maybe seen that more. So I'd love to know what you're thinking about the relative opportunity in like fixed income versus equities, going back to one of the conversations we were having before this went off track, thanks to the diluted butterfly folks. Oh yeah, your username's Jeffrey the Giraffe. Okay, get out of here. Guys, it's not, I don't care. We don't care about getting a large quantity of accounts. A lot of the apes seem to think that's what we care about. We'd actually much prefer to have just a constructive conversation about financial markets and what people are thinking about different investments and sectors and the like. Has nothing to do with your worthless security. So again, go do something else with your time. Would prefer that.
I wanted to state a concern that I had. So all these guys that just got their shares canceled with Bed Bath, some of them, not all of them, but some of them are actually buying into PHM, Pulte Group. And
yeah, that's the grift.
It's the world's worst grift because Pulte Group's stock is going to get smashed in the coming months. They have earnings next week, and all the home builders have contracting margins. Like their net profitability is going off a cliff right now because of high interest rates. And these people are buying that stock. Maybe I'm biased because I actually have puts on Pulte directly, but a lot of people that I kind of roll with on Discord are buying puts on XHB too, which is the home builders ETF. It's not looking good for them. And unfortunately, if these people are putting their reserve cash that they have into PHM, they're going to lose on that stock too. And I don't even understand how it's a grift. Like what's going on? Like it seems to me that Bill Pulte wants to get elected back to the board of directors on Pulte Group, right? I guess he was casted out a few years ago after he sold all of his shares. But number one, I don't even know if this guy has a position. I haven't seen a filing showing that he has substantial ownership in the company or anything. And number two, this is like the worst time to buy that stock, especially with the disconnect in the market with equities. They're going to get destroyed. I would not be surprised if the stock goes down $10 a share soon. It's bad luck almost that Bill Pulte.
The grift seems to be that Pulte, for pretty low outlay, has gotten a lot of hyperactive social media
antagonists
that can do his bidding, which is kind of what you were saying. I think he obviously doesn't like the current management of the company, even though he used to be on the board. He's not. I mean, he's just a fucking joke, to be quite honest. I saw him debating somebody about the bankrupt Bed Bath security. The guy clearly does not know how to actually read any financial statements. So he's just inherited a lot of money, and a lot of people are attracted to that sort of thing. And unfortunately, Butterfly Pelosi. Well, there's another one that's easy to get rid of. Bye. Bye, Felicia.
Butterfly Pelosi? That's hilarious.
Yep. Yeah, Pulte followed GME DD account. You followed my personal account. You followed the Wook account. You followed all three of these accounts, and this was years ago. So I messaged him and I was like, hey, I noticed his big following, and sent him a message and just said like, hey, if you're interested in learning more about GameStop or whatever it need be, I mean, I saw you follow these accounts. Like, let me know if you'd like to have a conversation at some point. And he never really responded to that, never initiated any sort of dialogue post to that. And it does seem that he's seen the opportunity amongst this very enthusiastic crowd of retail investors that are very passionate, that are willing to spend.
Calling them an investor does the word investor a major disservice.
Well, can't call them anything else besides apes, and I just want to make it clear we're talking
That
about
is
people.
not, I wouldn't use the word investor. I would call them rank speculators. They believe that they are buying moon tickets. They believe these are a better risk-adjusted return than the lottery tickets they would otherwise be buying with their money.
Well, putting
They have no
opinions
interest in the
aside,
long-term
it
business
seems
performance.
like
They have no interest in understanding valuation. They have no interest in anything but trying to sell to the greater fool at a higher price. I don't consider those people investors.
okay. Well, putting opinions aside, it seems as if Polte's identified a very enthusiastic group of retail traders,
Speculators, traders, sure.
speculators, whatever you want to call them, retail heads, and he believes he can get their support for an activist campaign in the home company that he's since been pushed out of. That's what it looks like from an outside
Storm and
objective
Norman,
lens.
you should not have put a butterfly. Bye, Felicia.
So it's that's what it seems like to me. Doesn't seem like he actually has any interest in making large investments in these securities that he talks about. Seems like a lot of it's just to garner public support for his own activist campaign, of which he's always tweeting about.
Well, and if he actually cared about these people, he would actually tell them probably that they shouldn't buy PHM right now, because home builders in general aren't something to be investing in at the moment. High rates are killing the housing market.
Hang on. But Randall, this is the thing, right? There's nothing wrong with if you want to express a view that, you know what, I think that long term, we're talking many years. When people are talking long-term investment, we're talking at least, I mean, look, yes, from a tax perspective, you got to go over 1 year for it to be long-term, but I don't think most serious investors would consider a 1 year holding period long-term. I think you're pushing up on at least 5 years. Beyond that, I mean, structurally, there is a underbuilt housing in the country. So could you make the argument that, hey, I'm looking out 10, 20 years and I want to own home builders? Sure. But to the point you're making, that in the short run, will the price likely experience declines? I mean, that's part of the risk of any investment strategy. But a lot of these, again, people, I don't think they're actually thinking anything long term. It's really just, I'm trying to get rich quick, and it's just the world we live in.
Cohort, you've
Hello?
made it up here. You're a speaker now. Looks like you've unmuted.
Hello?
Go ahead. Yeah, we can hear you.
Oh, okay, great. Yeah. So yeah, I'm a small time. Well, it's not small time. Medium sized to small home builder. I'm in a Discord with Rocket Randall. So we've talked about housing, and we just had our HBA board meeting last night, and all the builders were as bearish as I have ever seen them. But lots of them haven't gone through a full cycle. Going through like 2008, we haven't had a business cycle in the last 13 years. So it'll be interesting to see what happens. But a couple points I'd like to touch on that you guys already talked about. The interest rates work both ways. They affect supply and demand, and we're seeing both of them in action. So demand has bottomed or gone down to like 1996 levels, but supply has cratered right along with it. And you brought up the Prop 13 California property tax, which has a lock-in effect for that's been kind of proven in California. Well, the effective mortgage rate on everybody's mortgage rate, because everybody locked in mortgage rates at like 3%, is like 3.86% right now. That, I believe, has a lock-in effect for the whole country, and that's going to last for years as people are locked into their mortgage rates, and they're not going to, release supply into the market. At the same time, builders, some of small home builders, can't access banks because their credit was crushed by 2008, and they've been, either accessing private money or if you build homes for other people, you get 10% down, you get 25% when you put in the foundation, 25% when you get a lot of money up front, and you can build spec houses off of building for sale product. So you can build a spec house when you sell like 3 houses pre-sold for other people. Well, when the pre-sold stopped, so did the spec homes, because they've lost their funding source, because it's like the float idea. You can get a bunch of cash up front, and then I personally borrow at prime minus a quarter on my line of credit, but most builders probably don't have a line of credit, and that's why I differ from Rocket in that I think the big home builders have a structural advantage that I can't compete with. They have cash in the bank, and they have, like, I forget what Lennar's adjusted borrowing capacity is, but it's like 4%. And so they can buy down rates. They can do all these things that I can't touch, and they can put up product and hoard labor and et cetera, et cetera. And then you mentioned work from home. I do think that obviously it's interesting that Elon said that, but it makes your house value go up and your car value go down if you work from home 10% more or 20% more. So that's it.
Just want to make sure, is this alert?
Yeah, I'm alert
okay.
penis or
Cool.
alert.
Yeah, no. No, cool. Appreciate it, man. I've always enjoyed hearing your perspective, and it's good to get what you're hearing, that sentiment's pretty sour.
Yeah, it matches
among
the
your
HMI.
peers.
Yeah.
Mm-hmm. Well, thank you for sharing that.
And so I did sell a spec home in the frame last week, and I sold.
Are you out in Pacific Northwest, or am I thinking of somebody else?
Indiana, northern Indiana, near a certain university. I probably just narrowed it down. But I'm still building specs, but I'm building a very different spec than I was like a couple years ago. I'm building specs for, boomers, people who, 40% of people in the country don't have a mortgage, and when they sell, they have all that equity. And so there is transactions. There's 10,000 home sales a day still happening every day. So it's not like nothing's happening. And new home sales are the largest percentage of those sales that they've ever been. Typically, we average like 11% or 10%, and we're at 30%. So our 2023 was better than I ever expected. And in October of last year, I was very bearish on the economy and my year moving forward, but we did far better. And if we have a recession in 24, I mean, I was prepared in 22 for a recession in 23. I'm way more prepared for a recession in 24 than I was in 20. Anyway, so, but yeah, I do think there's going to be a lot of people who get hurt because they haven't gone through a business cycle before. And that's not just in home building, that's in all businesses.
Yeah, that's a good way to put it. And cycles are a reality. People have not had to experience, I guess, the downside part of that for quite some time. And if you're my age or younger, not in your lifetime. So it's definitely understandable. A lot of people just they haven't seen it before, so therefore it doesn't exist to them.
Yeah, and not financial advice. I don't know anything about home builder stocks right now or in the near term. I'm just saying I can see why, Buffett bought some, or, people are structurally long term, like you said, like 5 years, that they're going to just take more and more percentage of the market from small and mid-sized builders, because especially if there's a washout.
I know it's probably a local thing to kind of the northern Indiana market, but from a labor, are you seeing any capacity to pay construction labor less than maybe what you'd had to pay, or what's the labor trend looking like?
So we're very close to a little place called Elkhart, which is they build
The RV capital of the world.
Yeah, they build 90% of the RVs. So they Thor obviously is hoarding labor. They're not, they're just they're going from 4 shifts to where they're no overtime to cutting shifts and cutting hours. But we've seen, and then you don't want to hire the first person out of the factory, because unless you want a bunch of meth heads on your job site. But the first people they're letting go are probably not the best. But we've noticed a little bit of labor, and especially in like framing and drywall hanging, which some of the lesser skilled, but skilled labor, plumbers, finished carpentry, highly skilled labor is super tight. And that's a structural problem. We haven't invested in those areas in the last 10 or 15
the skilled trades. That's a consistent theme I see everyone talk about. Doesn't seem like it's just one geography, that there's just not enough supply of labor in those, whether it's electrician, plumbing, carpentry, what have you. I remember working for my dad when I was in my teens, hanging up drywall, and that certainly didn't require anything other than grunt muscle. But that's one thing I had thought. I think people who know me know I'm not a fan of the prior administration, but encouraging more apprenticeship type programs, encouraging young students to consider trades, and that was something I thought that administration did a decent job on. And I don't know I've heard much from this current one, or as much from this current one on that front.
No, especially from Biden, is going to be demand side. So they're going to roll out some first time home buyer thing, I'm sure. You mentioned affordability. All housing policy attacks demand, and that just makes it worse. So with their infrastructure pack, I don't know if there was anything in their infrastructure package for apprenticeship, or who's going to build all those the green projects and all that, because we obviously compete. We have one of the battery plants, I believe, is still going forward. I know some of the battery plants were, but we're getting one in Indiana, where they were pausing the one in Michigan due to the strike, but the one in Indiana was still moving forward. But all that labor competes with housing labor, and the build back better, and what was the other bill? But construction labor, I believe, is at an all-time high, even though we don't have enough to build houses, which is crazy.
Well, and then the other issue is, and there have been several different examples of this, where the manufacturing has been attempted to be brought back, whether it's, say, the Stanley Black & Decker. They tried to bring it back to Fort Worth, and they just couldn't with the labor force and the skill sets we have here. All right, yeah, Richard Shelby, block removed by.
I read a little bit. What was the story on that? They were trying to make an American-made.
Right. Exactly.
And didn't they make like one set, or like? I remember reading an article where like they're basically collector's items.
Yeah. Right.
But they spent billions of dollars to build, a handful of tools.
Exactly.
Yeah, we talked about it in one of the Wook reviews. I'll see if I can pin it, if I can find it.
But it like we haven't developed that muscle in America, or that.
Well, it's not that we haven't developed it, right? It's that the muscle atrophied away in that case, right? Because that stuff did used to get produced here. And then in the case of say TSMC in Arizona, also the murmurings of, well, the ethic of and the skill set of the labor here for that is just not on par with what it is in Taiwan. And obviously there was the Foxconn plant in Wisconsin that was going to cost however many billions of taxpayer dollars, and another boondoggle. So like a lot of this stuff, like you said, does all attack seemingly demand, and it's not really remedying some of the structural supply constraints for some of the skilled, I guess, labor, which isn't going to get fixed overnight. And unfortunately, it's still more attractive for a lot of them to locate now in Mexico. With if you're going to go to one of the states close to the border, you're going to get a much lower labor cost. Your transportation cost is going to be only marginally higher than it would, say, if you were U.S. based. So I mean, I still think longer term, that's a very kind of, if you're bullish on trying to bring manufacturing closer to the end consumer, it's less maybe U.S. bull, more maybe Mexico bull, and what are the logistics and transportation kind of plays that relate to that. I mean, that's been the case. I started at Ryder in 2017. I remember it was only murmurings of that sort of stuff in 17, 18, but it absolutely picked up even before COVID hit, and it really went to another level when supply chain resiliency became the name of the game amid COVID. So I don't think that trend reverses. I think that's going to continue. But Monative, nice to see you up here. Hope you had a nice week, sir.
Good afternoon, Rod. Good afternoon, everyone. What a week, huh?
What a week. VIX at 21.
Well, that
feels like it could be higher.
That still understates the risk. I think there's a lot more hedging going on with zero DTEs and weekly options. That VIX is not showing the real risk in the market. So, interesting week, yeah. Very humbled. I feel a lot of my positions are, hit, but thankfully I have very large positions that work. So, it's a balance. But yeah, not been a good week. A lot of things that I positioned for are not right or way early, which happens a lot because my positioning is typically to find trend exhaustion, and that's very difficult to do. So I do end up being early a lot of times. So
is the tech let me ask you this, is the tech divergence from everything else gonna revert?
No, I don't think
so. Is tech gonna join everything else going down?
So here is what I think, right? I think I still completely believe my thesis will work out once the dust settles here in the next month or so. But I think what's going to happen is I expected the breadth to narrow dramatically. I think it's going to narrow much more than I said it would. We're going to be left with in the S&P 500, probably less than 20% of the companies, carrying the, market as much as they can, depending on, I mean, look, if an Apple and Microsoft lose it, your S&P is not going to be green for a long time to come. But the internals can still be, okay, as long as, somebody else takes over the leadership. So the leadership has been communication services for a while, right? Google and Meta have been carrying it, and Netflix, did well for a so-so quarter. So we'll see. I mean, there's still, I still believe that the market implications of continued ad spend growth is good for communication services, and I still believe that will be the leader in the market. But growth in ad spend should also dramatically help Amazon, because they're the third largest online ad seller now. So they hold 9% of the market already, and it's growing. So that's I still like these three among the mega caps. I still like these three the most: Google, Meta, and Amazon. Whether they are buys here is a different story. But if you have them in the portfolio like I do, I still like them. I'm not getting out of those. I think of the lot, Amazon's probably going to do the best just because of cost cutting. They have that lever that they use every 2-3 years. They go through a big spend cycle of about 5-6 quarters, and then they cut it back to the bone for about 3-4 quarters, and the margin runs like crazy up, and then they start spending again. The margin crashes down to 3-4%, the retail margin, I mean. So the expectations for AWS are rather low because they've underperformed the rest of cloud in the last 3 quarters. So, as long as they show a pulse there, they're probably going to be okay. So given the outperformance I expect in retail because of cost cutting and in ad spend, helping them gain more market share, I think Amazon's earnings should come in, well above expectations. That's what that's my bet. I'm not suggesting it for everyone.
Sure. Speaking of retail, I saw the Port of Long Beach yesterday had its busiest ever September. So you figure LA and Long Beach are still the primary kind of import locales for goods coming into the country to get distributed from Southern California to wherever their endpoint is. I am definitely curious if anyone's hearing much. I mean, we're obviously only a month-ish away from like the Cyber and Black Friday and all that stuff. It has seemed for the past couple of years that there's been a continued pulling forward of spend from consumers earlier into October for holiday. And I wonder, like, okay, record September for Long Beach, even though it's broadly not been a great year for import volumes. From what I'm hearing from the transports that have been reporting, and obviously there's been a lot that happened in the last day or two with the convoy, now shutting down on the freight brokerage side. It seems like there's still a lot, and if you believe Craig Fuller, he believes there's still just a lot of excess freight capacity that needs to come out of the market, and it's just been taking longer than anyone would have expected. But none of the transports I've heard seem to think that we have bright green shoots ahead of us. They like Night Swift. I think that they had to say, shoot, I closed it, but they know we're still dealing with destock. JB Hunt, even though I think intermodal volumes were maybe they were just slightly up. Like no one seems to think that the destock's in the rearview mirror. It seems like we're still digesting it. And now what I'm curious about is like, do we see where maybe consumer ends up spending more in the front half of the holiday season, and then we get later into December and people are maybe freaking out that the consumer is not as robust. But I guess we'll just have to see.
Yeah, I mean, look, that's totally possible, but we're still talking about full employment here. We're still talking about a healthy labor market. We're still talking about most retailers having big hiring plans, if not larger than last year. At least Amazon's probably a standout there. They're hiring far more than last year, or planning to hire, I should say. There's really no hiring yet. These are just announced plans, so we don't know. That could change dramatically. But this, I think this has been the struggle, right? We're looking for that data to break down, and if it's breaking down, it's not consistent there, right? It breaks down for a couple of quarters and then it shoots up, and then it stays flat for a while and then it breaks down, a couple, or not quarters, couple of, trends. I don't know. I mean, it is very difficult to see an imminent breakdown in the economy. Is it slowing? I'm sure it's certainly slowing in every measure if you look over an extended period. But I still don't see an imminent recession now. I'm sure it'll come, but it doesn't look like it's around the corner. So we might, you know, skate through this retail season okay, if not great, at least okay. That's my take. I just don't see a massive red flag on the horizon yet for the economy. Individual companies and stocks, yeah, there's plenty that's going wrong, right? I mean, look, even in a market like this, Lockheed results, in my opinion, were pretty pathetic, right? Book to bill of zero point 0.9, which is okay. That's just a timing issue with F-35s because that's such a large outsized program. But the mission fire control sales, given what they should really be selling, they should be making as much as they can and selling all that and more. It's not even good, let alone great. So there's a lot that, but the price action, right? Last quarter, 1.6 book to bill and it sold off. This quarter, zero point 0.9 book to bill and it's held up. It actually went up a little bit on earnings, which again, were not good, but it and the guidance was not good either. It was flat. So, price action says that that sector is, or that industry is going to do fine, right? Which is why people would still not sell it off after such a report, is the expectation that continued geopolitical mess would keep them afloat. So there's a lot like that, right? Netflix results, right? It's not the results again, right? We've gone back to paying greater value to growth rather than to immediate financials. And that much was clear in Netflix, right? It's rallied, what, 30, 40, $50 in a couple of days from earnings, just because their subscriber growth came in so much higher than expected. Again, right, it's a good thing. It doesn't mean that, they've monetized it yet. So the numbers are at best okay. But you saw that big run, which you wouldn't have seen last quarter. So subscribers, again, right? What is the market valuing? Is growth at any cost suddenly becoming a thing again? I don't know. We have to see. It'll take 4 or 5 weeks to judge if the market is paying premium for growth, right? Because most of those kind of companies are yet to report, or will not even be reporting this month. Most of them will be reporting next month, but that remains to be seen. So there's a lot. I think there's a lot of problems at an individual stock level, but I think less problems at a whole economy level around the corner. Down the road, yeah, I get it, but around the corner, I don't see huge red flags.
All right, Mohammed, appreciate it. David, saw you come up. Would love to hear what you'd like to add to that. And then again, just the timing wise, we'll probably wrap around 6 o'clock Eastern. So we started at 4. So just time check. If anyone wants to request to speak, feel free. We'll wrap in about 35.
Hey, thanks. Yeah, I mean, the tape action is absolutely horrible. The market does not jive with economic numbers whatsoever. I think that's kind of apparent over the last couple of months. But you've had yields in the 10-year, go up, 50% in a matter of since the end of June, and so many people wanted to think that the Fed's going to pivot and it's higher for longer. They ran stocks up, and I think everyone was trying to guess that pivot, saying the market was going to bottom or things are going to get tough. And I guess my opinion, I think the right hand side of this business cycle is going to extend further, and it's going to be still rates higher for longer, and it's going to be L-shaped and not V-shaped. I think rates are finally making people wake up that the Fed's not pivoting, And, the Fed's goal is to get one thing under control, and that's inflation. It's going to come at the cost of jobs. With Monativ's comments on Netflix, I agree with them. I mean, I think, even in inflationary times of the 70s, you wanted to own equities that grew faster than inflation, period. When you look at, some of what I think the Netflix may also underneath be revealing is that people are cocooning again. And cocooning was the term that we used, after 9/11, and that's people staying home. They're not going out to restaurants. You can see that in the restaurant stocks, so they may be benefiting from people deciding to cut costs of going out and perhaps staying home more often. And, that's a possibility. I can't say for sure. But, you can certainly see that in the retail stocks as well. I mean, come up, if I hear the economy is good, other than, 8 to 10 retail stocks, it's not good. I mean, the numbers are certainly not coming out better than expected on a majority of them. Most of it is volume decreasing with price increases, so that's how they're making their number. They're driving even more inflation by, continuing to price products at a premium rather than reduce them due to the slowdown in volume. I guess that's what I see on the top line. And Monative, I'm sure you can add to that much better than I can. But
And to agree with kind of your notion there that it is still very top heavy, S&P 600 now down over 5% year to date. S&P 400, the mid caps now down over 1% year to date. So it really is still largely held up by the big boys that have seemingly, the market said, will be the next Nifty 50.
yeah, and that's normal through, a cycle like this, is people head to quality. I think what's surprising everyone, including myself, is how long it's lasted, right? And it's, when you start to get breadth so narrow that, the only way to outperform is, and it's more than 7 stocks that have held up the market. But, is it greater than 10%? I highly doubt it. It's somewhere, in that, 10% range at most. So, when markets happen like that, I can't ever find a period which, the market, went up for a long period of time with just quality leading, until you get a pivot,
And the part that's been curious to me, David, is I agree. These are some of the best companies ever. But like, okay, if long-term rates were knocking them up 100 or 200 basis points, I mean, these companies have a lot of value in the terminal part of the DCF. And I would have thought that they would actually be treated more like long-duration assets, but they have yet not.
Yeah, it's, but, you look at American Express's earnings yesterday and then go look at the chart. If that was good, at the end of the day, everyone's performance, every portfolio manager's performance is based on the price of a stock, period. Not how good the quarter was, not the great things that are said. And you look at the price patterns, on many companies after they report, the stocks are telling you something different than, what the headlines are saying. I look at, the news coming out on American Express, and, it's mostly the headlines are bullish. And then you pull up the stock chart and it's like, what the hell did I miss? And it's just a fanciful headline, with charge-offs, being increased for the next quarter, but everything's fine. It's that type of, terminology that's being used. And, the price is certainly responding differently than what a lot of the headlines are. So that's what I'm seeing.
So, I mean, look, it's the way we've set up the market. There's a lot of structural problems there, right? But the way you measure it, David, it's what it is, right? Again, we are going to have an overall S&P earning that is going to come in better than expected this quarter, but that's not because the things are great. It's because how we measure it. And if you use that metric, and for everybody that uses that metric as a headline, this is an overall good quarter when all said and done, right? When it is done in about 8 weeks, 9 weeks time. or 7 weeks, 8 weeks time, right? But the point I'm trying to make is, it's unless we make a significant change in the way the averages are, I mean the indexes are set up and how we benchmark performance, it is going to get skewed, and it's going to be lack of understanding that drives this, right? I mean, Magnificent Seven are a very large part of earnings. And if I look at a rough number, they are supposed to contribute about 73 billion of the what was it, 470 billion of S&P earnings this quarter. So 73 billion would make it about 15% or so. Now their market cap is larger than that, but the earnings growth rate is high, which skews the whole S&P, because the bottom of S&P, and you and I have talked about this, the bottom of S&P is just trash. S&P 500 is really S&P 300 plus 200 shit.
Yeah, and I agree
The
with that.
S&P 493.
Monative, what is the backbone of the country? Is it small business or large businesses?
I'm not, David. Of course, it's small business.
Okay.
I'm not disagreeing with you,
Yeah.
but the way the market is set up to work, it is set up to work well with data.
Absolutely. And I guess what I'm, my view is, if, as we all know, small business is the backbone of the country. And if you start to have a lot of bankruptcies in those areas that can't get financed, those are a lot of the big companies' customers, a significant portion. And they don't get the deals on being a small company. They probably pay a premium for a small, portion of their revenue over, but they're not getting discounts because they have 1,000 users, on a SaaS system. So what I'm trying to say is, if you have a lot of bankruptcies, this is kind of like the back door, the opposite of '07, '08 financial contagion is that you're starving capital from small businesses that cannot operate. And if they go into bankruptcy, and if there's enough of them, you're going to be taking a line of revenue away. And I don't know what that proportion is to these large companies, but it starts a chain reaction up. And, look at what biotech is doing. Go look at Illumina. Look at everyone that sells into the biotech chain. They're being affected because their end client is disappearing at a very fast rate. And that's what I guess, a thought process that I'm presenting that I have not heard anyone talk about, anyone discuss. It's not come up in any conversation. So, that's a perspective. It's interesting. I was on a call with Cantro last week, and we were talking about, the IWM, and yep, 40% is crap. It should underperform, absolutely. But, if you take the SML, which is the S&P 600, and it's required that they have to have a profit, that's a 6-month relative strength highs against the IWM, but it's really only outperforming by 2%, okay, for 6 months versus the IWM. So, that's being sucked down the tubes, and you are starting to see a differential, at least, from those that were the baby thrown out with the bathwater, per se. So, you are starting to get a trickle down into the profitable small caps. I'm just, from my perspective as a technician, I like to buy stocks when 51% turn the corner and start to go up, instead of picking the 8%. And not that I'm not a stock picker, it makes your job that much harder as a portfolio manager or as an investor. So that's the perspective I'm just presenting, and I agree with you all the time, Monative. And it just, that's the way it is. And it's not the market you may want; it's the market before us. So
Talk about XBI, right? It topped in 2021 Q1. Who even remembers 2021 here? Q1.
Couldn't
It's been
possibly
it's
forget
been
first quarter of 21.
yeah, Monative, I'm not
it's
talking
been
about
down
it's a bull
since.
market for it. I'm saying
No, no,
it's
no. No, I'm agreeing
Yeah.
with you, but the point there also is this market ever since, I mean, more starkly since Q1 of 22, has been a vast divergence between haves and have-nots. There is a certain set of companies that do well, and that percentage varies dramatically, right? If you took Q3, it was maybe 15%, 20% of 22. If you take Q2 of 23, it had gone up to maybe 40%, 45, 50% even. And now we're back to about 30%. And I think it goes back to 10, 15% by the end of the year when we start reporting, Q4 earnings in Q1. But doesn't mean the opportunity is not there, right? Look, we're investors. What are we going to do,
Yeah,
right?
absolutely. And the market looks worse to me as a technician, and I was all over the market at the June July low as being the market's pivoting. The October low, I got that, but I'm finding less and less names from what I do. And that you can focus on earnings. I have to focus on stocks, inflections, and that type of thing. But I'm seeing a lot more. Top patterns across the spectrum, which obviously the S&P now, a lot of large caps are joining in. I didn't see the news on what happened to Oracle today. That's like used to have a lot of names pulling back to the 200. Caterpillar did it. It's just not a perspective that I want to go, oh, it's got a hold there. It just is not a chart that is constructive at all. And my concern is, again, what I'm trying to relay on the biotechs is, again, those companies that have the biotechs as the consumer of goods within the whole healthcare spectrum, SA kits, anything like that is being torn apart. And what I'm saying is, if small businesses start to fail at a greater rate, and we do see a lot of bankruptcies coming, you see warn notices are, I think at the highest by a substantial margin in the last month than you've seen anywhere throughout the last 2 years. If those continue to climb, I'm just saying the small companies going away will start to, the large firms are going to start to lose clients. And then you're going to be dealing with a revenue decline that you can only cut costs so much to make your numbers. And it's just a different perspective. I may be wrong. I may be right. I haven't heard anyone discuss, the economy in that manner at this point. That's all I'm trying to suggest.
To be fair here, it's not about whether you're going to be wrong. It's when or right. It's going to be when that happens, right? And that's what we are disagreeing on. So I still think we are looking at, a further dive in economic data coming in second half of 24. Not certainly not this quarter, and certainly not next quarter. I think deterioration, as people term it, as like a recession, I don't see it coming now.
Yeah.
I see it coming.
And from my perspective, I don't care. I don't use the R word ever. Why? Because I still have to find good stock. So it's irrelevant to me. And timing is a fool's game to try to declare when the recession is coming and when it's not. We've seen that. Just like I don't like to pick the S&P and what the S&P is going to be at the end of the year. Last year, S&P was down 25%. Energy was up, 85%. You could drive a couple ships through those numbers. Either you were overweight energy or you were underweight and you lost even more than what the index turned in. So, that's just the way I look at the market. And, when you're running out of places to overweight because they're all on an absolute basis going down, that's just not, that's just, it's called being less of a bear on something and more of a bear on something, but you're still a bear. So. But hey, I have to chime out. Monative, great to talk to you, buddy. Always good to hear you. Okay. Thanks for letting me up, Wook. Appreciate it.
Yeah, thanks, David. I mean, to build on something that David was saying about the balance sheet situation broadly of these smaller companies, it is true that they have shorter duration debt maturities, all else equal, compared to their larger counterparts, and they have a higher cost of debt, and they have more variable rate debt. So it's played out in a way that he's right. There's going to be pain. There's going to be a lot of distress. There's already been some. You mentioned the warrant notices ticking up. There will obviously be a lot of these smaller companies that look to restructure their debts or sell or whatever the resolution ends up being. But I kind of agree with his, and Amanat, I think we talked about this a week or two back, that if those companies are buyers of the services from the big players, if they're feeling the burn, they're going to buy and consume less cloud from insert big cloud provider here, less whatever cyber security services, whatever it might be. Like, it does feel like there's going to be a shoe that drops. And while I agree with you that clearly the labor market's still strong, and it's been good to see the loosening of it somewhat. I mean, the beige book this week, I think, aligns with kind of what you would want to see broadly if you're a Fed, if you're a Fed watcher. I mean, clearly Powell made it clear we're not going to have a hike in a couple. How many days is it till the next one? But like, you've just got this problem, this large debt balances for a lot of companies that are unprofitable, and that it seems like has been kicked for a long time now, and it's like we're going to face the piper, and I don't think anyone knows how the system digests all of that.
No, I don't disagree. I think there's a lot of very questionable. Forget small companies. There's a lot of very questionable balance sheet in S&P 500, right? Let alone even wider indexes. There's a lot of crap there, and the ability for cash flow to cover interest payment is pretty questionable for a lot of them, right? So they're going to have problems when you start rolling debt, when you start having maturities come up, and they have to they don't have the ability to pay that off with cash flow. That means they have to roll it, right? And that's going to be problematic. But again, it only matters if you want to be in those names. It only matters if you're widely distributed within the S&P, right? Like using an index ETF, for example. I've been saying this. This is not the time to be in index ETFs. You have to be picky. You have to be really, really concentrated in a certain in a few themes, a handful of themes that are working. I mean, even today we had a problem. We had a cyber attack that took down Okta, right? I mean, they didn't get attacked, but something happened that was potentially an Okta client, and Okta went down 10% or something like that. Cybersecurity budget's not going down, but within cybersecurity, you can't just buy the whole index of cybersecurity or cybersecurity ETF, because there are companies that have trouble closing their deals. There are companies that have to discount heavily to close their deals, and there are others that are able to manage that far better by giving easier terms or packaging other products or adding functionality, whatever it is. They're able to, or they have other things to throw into the mix to to sweeten the deal, right? Like a Microsoft can take market share in a situation like this. Their Azure AD can take Okta customers because they can package it as part of a much larger deal. Okta can't do that necessarily with their customers, so they have to discount heavily, which means they're gonna. I don't know this about Okta. I'm just guessing here with a direct competitive product. Point I'm trying to make is, even in a theme that's working, you have to be highly selective. You cannot be widely distributed within the theme. Every single area that's still working is still working in a very narrow sense, and you're either in the right place and positive or in the wrong place and deeply negative. That's the way it is, and it's going to narrow further. You're going to I don't know. I still think we're going to have about 50, 60 companies that work very well at the end of this earnings season, and what, that's 10-15% at best. That's where I think we'll go into Q4 earnings in January and February with a very small percentage of companies and teams working, and and the rest really in different stages of a mess, right? It could be serious drawdowns or flat. I don't want to be in a place which is flat, right? Like you guys have been saying for the longest time. When you can make 5% somewhere else, why would I want to be in a stock that's flat?
For
So,
sure. And that was something I know we talked about, like Howard Marks' memo, what was it, last Friday, whatever day it came out, talking about that, the notion that high yield credit right now you can get, let's call it 9%, and own a credit instrument instead of an equity instrument. And like his point being that what the relative riskiness of equities right now, given what yields look like in the credit universe. Look, he's obviously a bond guy and will always skew to that, but it's a valid point. And to add to that, in the high yield stuff, I had seen a Moody's analysis a couple months back where it's like almost 2/3 of B3, so speculative grade credit issuers in the US were going to have interest coverage ratios below 1. So that's with the Fed funds, sitting where it is now. And it's just going to, I think, become more acute next year as the higher for longer sets in for maybe more of these issuers who have maturities later in 24 or in 25. You're going to have to restructure things. And I don't see another way out of it. But I think the relative attractiveness of credit versus equity, it's hard to think it hasn't been more attractive like at any point since maybe the GFC when things were going haywire. But I don't know. Do you have thoughts on that kind of dichotomy, Monative, or anyone on the panel?
well, for what it's worth, Archana, you're listening, but yeah, I bought my first TLT leaps, yesterday. So,
Leap calls?
TLT calls, yeah.
Gotcha.
So
one thing I heard somebody mention earlier today that I'd never heard of before, in a space with Turtle Capital and Jimmy. I don't think they're in here right now, but he was talking about TLTW, which I hadn't realized there's a buy right strategy for TLT. And with how high bond implied vol is, I wonder if those strategies, might be interesting, or even like a calendar strategy instead of just the long leap, maybe write the earlier month calendars, given how high volatility is. But I don't know if you guys, and I know Archana would love to hear her thoughts if she's looked at some of those trade ideas, given the bond market's volatility.
yeah, that stuff is beyond me. I just call her and ask her what to do. So easier. That's my cop out on that. But again, right? It is really important to be selective now, right? I mean, even defense. I keep talking. Don't just rush into it without understanding what the thesis is there, right? You're gonna end up being my exit liquidity if you're if you're diving headfirst into defense right now.
Hey, Archana.
So in terms of,
Energizer,
can
I
I
also brought
speak
you up to
about
speak.
TLT?
Please.
Yeah, can I talk about TLT? Yes, volatility is high. So if you're buying a leap, you are getting lower volatility. The volatility is high in TLT. So you can buy a calendar, but if there is any intervention or if there is any flight to safety in bonds, it's going to be a big move. Like what? Calendar been having a slow and steady move. Is that what you are expecting? If that is what you are expecting, then yes, calendar makes sense. But if TLT moves, it's going to move big because it has been, there are so many people who are short, right? All of a sudden, somebody has to cover. So I would not go in that direction. But
No, he was
TLT,
asking. He was asking about TLTW. Do you know what that is?
no,
I've
I
never.
don't know anything about TLTW.
It's just doing like a front month call writing strategy coupled with TLT.
Yeah.
You're paying somebody 35 bips to do it for you.
Yeah, that is there. There are so many such, even JP Morgan and all that stuff. They have all kinds of ETFs now, managed products. And that's the reason, because of these managed products, we are having this issue during expirations. The flushes happen right on expiration or after the VIX expired. So we've had the bigger flushes because VIX expired on Wednesday morning after that, because till that time the volatility is more in check because of those sells, the amount of sell buy rights that they do. But we are at VIX above 20. I would, it could easily jump right now.
All right. Well, I think we're going to shut things down shortly here. Energizer, I had added you as a speaker. You dropped down. I'm going to add you again if you'd like to chime in, and we can let folks on the panel get their last words in after you speak, Energizer.
Sorry, Rod, I had to step out. Are you closing up here?
Letting people get their last remarks in. Yeah, I brought up at Edry Mayor, Energizer, your speaker. If you want to chime in, please go ahead, and then everybody else.
Okay. Can you hear me?
Can hear you. Yep.
Okay. So, hi everybody. I have a question? Do you all understand that whatever happened in Israel is a macro? It's event in the macro.
Yes, there are implications regionally and globally. Certainly.
Okay. So we all agree on that. Over TLT, we broke something that on a TA, I can say that the move down gonna be big. Now, if we're looking at a Bitcoin right now, it's driven by speculation only against the dollar, the speculation of what's going to happen to the US dollar. If we're talking about the VIX, I can say there is a change of course. That's why we literally went 1% down today, and the VIX ended up barely moving. So the market is calculating himself a lot in a price a lot lower. That's my right now what my portfolio is and directions is all about. Now the Israeli event what's basically was the top, I believe, of the economy in the next few years, even more. And I think we spoke one day about the depression. Now you can agree that there is a depression without the alcohol numbers or anything. We are in a big depression. There is something. I believe it started around COVID. So.
Yeah, I know you have that perspective, but the real data seems to disagree, given we're at maximum employment. And I mean, I get your point that things don't feel great for some swathes of the real economy, but I'm not sure anyone could really argue we're in a depression. Because if we're in a depression right now, I'd like to know what a real recession actually would be, and it would be pretty rough.
Correct.
But
And if you look at the stock market, we have a situation similar to 2001 to 2008, if you look at the charts. When you have the bubble of the money printing around the COVID against the bonding collapsing around 2008, same as what's happening right now. Now, the macro event basically in Israel gonna be, I believe, something that will affect the next decade. Though my only thing that I can say is the fast that things that are going right now. If you can compare 2001 to 2008, you're looking about 7-8 years. And when you're talking about COVID, the top of COVID and to here, you're speaking about a few years. So the time frame has been changed. Everything moving faster. Probably because technology, or maybe, I'm not sure, more players. I'm not really sure how to explain that.
all right, well, appreciate hearing your perspective, Energizer. It is top of the hour, so I'll go around cohort, Rocket Randall, and then Monative lastly, if you guys wanted to get any final thoughts in before we wrap it. Okay, well, yeah, Monative, go ahead.
Yeah, I can be really quick. Look, I have a portfolio of a good size for me at least, and I have to invest. I'm not satisfied with 5%, 6% I can get, and I'm right now so far I'm making more, and I'm happy that I am. I don't know if it'll last, so I can't be worried about what a depression will look like when it comes. I'm not waiting for it. If I sit back and do nothing, and I'm not going to make my numbers. So I invest based on what I see for now, and I'm positioned to get out as soon as I see that changing. My thesis is very simple. I spend a lot of time researching and I invest, and as long as that thesis is working, I'm there in the stock. If that's a day, so be it. If that's a year, so be it. And I get out if that doesn't work. It's as simple as that. There is still places where it's working. I'm not going to go hide out everything in bonds. Is there a place for bonds? Certainly yes, but it's not 100% of the portfolio for me. I cannot sit and do that. And each person has to measure that risk tolerance for themselves. For me, I have a pretty large risk tolerance, but I also have a lot of work that I put into to get into places where I put my money in. And I trust my research, and I go with the numbers that get published, whether the numbers are correct or not, and whether things are going to change or not. Yeah, look, I come from a data science background. I ran the entire data science team for a very large bank in Singapore, so I know when and how to look for data changes. And when I see those changes starting to happen, I will position accordingly. But I'm not going to sit here and say, what, this feels like 2000, 2001, 2010, 1970, whatever it is, the parallel is, and position for that now. That means I'm not trusting the data I see. I'm trusting the data I want to see. I'm not going to do that.
All right, Monative, appreciate it. And one other, I guess, corollary thought to that about looking at historical data is how we are in a very unusual time. You've got interest rate environment and the rate of change in the interest rate environment very unlike anything seen in the last most of our lifetimes. But for those of us listening who our elders generally, so it's definitely a challenging environment to be operating within. But Always very much appreciate, Monad, your insights and your thoughts on matter. I know he just dropped down from speaker, but I appreciated hearing the small builder perspective and what they're hearing, in Northern Indiana in the labor market. Look, the reason we do these is not because I want us to talk about any particular stock or sector, but it's to kind of hear those diverse perspectives, hopefully in a constructive conversation like I think we evolved into, even though we got a little bit hung up by the butterfly folk earlier. But that's the intention of us holding these weekly calls. We do them every Friday at the close. We're trying to talk about financial markets, talk about news and information, hopefully have someone who has some deep insight into things that maybe we don't. And that's kind of our objective. So appreciate everyone tuning in. We'll be back next week. We do the Wednesday night calls, which Joe hosts with me on the @GMEDD handle, the due diligence handle. So be sure to give that one a follow. We'll be on from about 7 p.m. Eastern to 9. We do these for about 2 hours on Friday from 4 to 6. So they're always available as well. If you miss any of it, we record them, and Joe also hosts them to our YouTube channel. So look, we do these to try and learn a little bit every single time. We're not trying to pitch you guys anything. So we very much, though, appreciate you listening in and joining and spending some of your afternoon with us. So I hope everyone has a nice weekend. Certainly stay safe out there to the extent you're able to. And we'll talk next week. So cheers, everybody.